All right, Mentors Collective. On this episode, we're going to learn how to save money from taxes. If you love paying Big Sam, Uncle Sam, large portions of your check every month and at the end of the year, this podcast is not going to be for you. So you can go ahead and leave now. But I've got my friend here, Karlton Dennis. We actually met in Chamonix, France on a ski trip. He is a YouTube celebrity. He is a registered agent with the IRS, and he is a tax expert. He teaches this stuff for free on YouTube. But I'm going to be, Karlton, digging a little bit deeper into your mind, talking about some advanced stuff so that I can learn how to save a bunch of money on taxes. So, Karlton, thank you so much for joining me. I'm pumped to have you here, brother.
Yeah, I'm pumped to be here, man. Thank you so much for having me on. I'm going to try to help as many people save as much money with this podcast today.
That's the goal. And I'd love to help as many people as possible. And to do that, go with a range of different income levels, because I know there's different tax saving strategies at each level. I've
Yeah.
implemented a lot of those things as I've gone from level to level. And then there's the ultra wealth level where I haven't reached yet, but I know the strategies change quite a bit. So let's start with level one, brother. What is like some basic tax saving advice that you have for people who are W-2 employees? They have a job, they're making some money. What can they do to save money on taxes?
Yeah. So, there are levels to saving money on taxes. And most people who are trying to save that are W 2 taxpayers have heard all of the boring write offs. And I'm not going to bore you today with the 401k or put money into a traditional IRA. What I'm going to tell you to do is if you're a W 2 employee, what you have to do is understand what the government wants you to do to save money on taxes because you've chosen a career where you're working for an employer. So you are going to be limited in the amount of write offs that you get to take to pretty much only mortgage interest, property taxes, and your retirement account. But if you decide to invest some of the money that you take from your W 2 job, such as into investment properties, this can open up some deductions for you. And so we have a lot of W 2 taxpayers that will invest some of their savings into short term rentals and be able to use the short term rental business as their main business to avoid taxes on the W 2 side.
Right. So you need an account, you need a business to be able to write off expenses, and you can't do that as a W-2 unless you have an LLC or an entity. Is that correct?
Yeah, so an LLC really provides you with liability protection. A majority of business owners will set up an LLC thinking that it can save them money on taxes, but all it really is just a structure to protect you in the event that lawsuits can happen from your business. So when you're ready to start saving money on taxes, we have to start figuring out what deductions can we take on the tax return that's going to offset the amount of income we're making on the W-2 side.
What are some examples of those deductions? What can people start thinking that this could be a tax write off? I could be saving money on this if only I was set up correctly.
Yeah, absolutely. So I like to do this in stages. So let's get all the boring tax write offs out of the way and then let's go into the fun stuff. So if I'm a W 2 taxpayer, I already know that I can put money into a 401k and receive a tax deduction. Maybe I'm
Yes.
making $100,000 and I put $25,000 into my 401k. I'm going to pay taxes on 75,000. That's simple math. But after you put money into a retirement account that you can't touch until you're 59 and a half, you're going to be looking for some other write offs to probably reduce your tax bill. And this is when investing into real estate can actually create deductions for you while you're earning cash flow at the same time. And part of the reason why real estate is one of those interesting investment vehicles is because when you invest money into real estate, you're receiving back such a big deduction on the tax returns that you're never really paying taxes on the cash flow that you're receiving from your tenants. And this is because of depreciation. And if you have enough depreciation on the returns from a short-term rental, you can use that depreciation to actually offset your W-2 income taxes. And this is where we can have a lot of fun with the tax code.
A lot of fun is correct. And I think last time me and you were shooting the shit over in Chamonix about a tax strategy that we used in our business. And that is we bought an office building for the company. We got a cost segmentation analysis done and then took a massive bonus depreciation. So real
Yeah.
quick, Karlton, can you explain what that strategy is and if it's something people can use?
Yeah, absolutely. So this strategy, we call it the self-rental. And pretty much when you're a business owner, you can choose to buy a property and have that property be associated to your active income business. So let's say that I'm running a marketing agency and I have an S corporation. Well, maybe my marketing agency has employees and we need an office to be able to run our business out of. So rather than leasing an office space where I'm paying rent to another landlord, I might choose to go purchase my office building. And by doing this, I am truly leasing this really to myself or to my S corporation to an active business. And if I perform a strategy called the cost segregation study, the IRS will allow for me to take a big write off on this building that I just purchased for my business. So it allows for me to write off maybe up to 30, sometimes even 40% of the building's purchase price
Mm.
all in 1 year, creating this massive deduction on the tax returns. And when you think about it, if your business is making good income, buying a building that gives you massive tax deductions could end up offsetting all the income you would have made that year. And maybe your business really needs that building. Now you're leveraging a tax strategy while growing your business at the same time. That's leveraging the power of the tax code.
Thank you. And I actually don't know the answer to this next question, but is that something that you can also utilize as a, say, short-term real estate investor, or does that
Yeah.
pertain mostly to businesses?
Yeah, so this is a great question. So, part of the reason why I believe the W 2 taxpayer has to focus on getting into a short term rental is
Mm.
because of this exact reason, Jay, that you took that write off for your business, right? The W 2 taxpayer needs additional write offs on the income they're making, just like you need write offs on your business's income. But a W 2 taxpayer doesn't have a business unless they're running a short term rental on average 7 days or less per customer. Underneath these special rules by the IRS, you have a operational business that's considered active. So if you place this property that you purchase on Airbnb or VRBO and you're renting it out 7 days or less per customer, you can perform the same strategy that Jay performed with his business, which is called the cost segregation study, and accelerate your depreciation on your property that you purchased. And so when we look at this write off on the tax returns, sometimes this write off is like a negative $100,000 or a negative 200 or negative 400 on the return. That negative amount that you see on the return is what we call a real estate loss. And that real estate loss can flow over to where your other income is on the tax return, AKA your W 2 income from working your day job, or even if you're self employed like Jay is, your 1099 income from your S Corp or your LLC. And it can offset all of that income, making you virtually tax free.
It was pretty incredible. It's almost like a free building, and I assume it works the same way for a house. The amount of tax savings that we got with that bonus depreciation was almost equal to the down payment on the building. And then
Yeah.
assuming that you're renting it out for break even or even maybe even making a few bucks, then your down payment's covered and your monthlies are covered. And now you're just building equity in this building or house long term, and it's almost like a free building, which is
Yeah.
pretty incredible.
This is part of the reason why I get behind real estate and the tax code heavily, is because when most taxpayers are asking me for ways to reduce their tax bill, they get bored of telling them, let's go spend money on a car, right? They don't want to always buy cars. There's only so many cars you really can have in a business, anyways, right?
Right.
But they get excited when I tell them, let's go buy an investment property and let's use this investment property to not only save you money in taxes, let's actually run it and make money from it. And this is how a real business owner can leverage the tax code and build wealth at the same time, with real estate being that tool.
There's so many fun, sexy tax strategies. You mentioned buying a car. I know there's an 8,000 pound car tax write-off that everybody likes to get into. So let's talk for a second about that. What is that all about? What is the eight
Yeah. So
thousand pound car tax write-off?
it's actually 6,000 pounds. And what the rule is a very special tax rule that was a part of the Tax Cuts and Jobs Act of 2017. If we go back to that time period, Donald Trump was in office, and it was very important for him to get something released that was going to be able to help him during his whole election. And so his big focus was on changing the United States tax codes by building out a proposal called the Tax Cuts and Jobs Act that went into effect in 2017 and really impacted everybody in 2018 when they started filing their first tax returns. And a part of the Tax Cuts Job Act, Donald Trump implemented Code Section 179 and bonus depreciation, which Jay brought up earlier,
Mm.
that I'm going to explain to you. What one Code Section 179 states is that if you have a qualified piece of material or equipment or even a vehicle that you're placing into business purpose that has a useful life of less than 20 years, designated by the IRS, then you can choose to write this item or vehicle off all in 1 year. And if you do this, you just need to make sure you check the box 179 on the tax return, letting the government know that you're choosing to make this election. So if this is a vehicle that weighs over 6,000 pounds, then it qualifies for Code Section 179. If the vehicle weighs under 6,000 pounds, then it does not qualify based on the Tax Cuts and Jobs Act ruling. Now, bonus depreciation is the tool that allows for you to take all of this accelerated depreciation all in 1 year. And that's the hence the term bonus depreciation. Because normally when you're taking a write off, you're normally taking a write off over the course of time, sometimes over the course of 5 years, sometimes over the course of 7 years. Sometimes you have to take certain components that you write off in your business over the course of 10 years, such as like equipment or machinery. But if you could choose to buy equipment, machinery for your business and write it off all in 1 year, you're going to reduce your taxes substantially, making you much more profitable and hence allowing for you to reinvest back into your business and hopefully provide more jobs. And that's why we saw a huge job spike right after the Tax Cuts Jobs Act was released, because many business owners were finding a lot of tax deductions from utilizing Code Section 179 plus bonus depreciation.
Interesting. So the 6,000 pound car tax savings is actually a bonus depreciation on the car. Is that correct?
That's 100% correct.
Interesting. I did not know that. So say I were to
Yeah.
buy, let's throw it out there, a $200,000 Lamborghini Urus. I think that qualifies for the 6,000. You see entrepreneurs buying that car all the time. How much tax savings am I going to see from that purchase?
Yeah. So in the year of 2023, the IRS has updated the tax laws and bonus depreciation has dropped to 80%. So on a $200,000 car, you're looking at about what, 160,000 that you can take in the year for the write-off. Now, in order to take 100% of that $160,000 deduction, 80% of the 200K, you need to make sure that 100% of that vehicle is in business use. And that's very important, because as a business owner, the IRS has a very strict rule when it comes to the vehicle. They say that in order to write off a vehicle for business, you have to be using the vehicle for more than 50% of the time for business, and you need to be documenting that. So if you're a business owner and you're trying to write off that whole 160,000, then that vehicle needs to be a business vehicle 100% of the time in the tax year. And then we multiply that deduction by your tax rate. So if you're in the 30% tax rate, 40% tax rate, we would go ahead and multiply that 160 by your applicable tax rate. So we'd be looking at maybe about $48,000 in tax savings if you're in around the 30 to 40% tax bracket.
That's pretty significant. That's incredible.
Yeah,
And
and it's
before we,
about similar to the down payment, right? Because you're going to spend
right.
somewhere around 20 to 40,000 as a down payment to get the vehicle, but then you're going to receive around 40 to $50,000 in tax savings. Plus, you get to keep that vehicle, right? And so it could be a business decision that a business owner makes to grow their business by not having to pay so much out to Uncle Sam and getting a vehicle that they actually need. And same thing for an investment property, right? Sometimes your down payment into an investment property can equal the amount of tax savings that you're receiving after you perform the cost segregation study.
Yeah. And now you see a lot of people doing the Airbnb for cars, which is Turo. You buy one of these cars and then you rent it online. Now it's 100% business. And you could stock these up over the course of several years, save a bunch of money on taxes. You've got a passive income stream right there. Very
Yeah.
cool.
Yeah.
Before we jump into kind of the next bracket, which is I think where I'm at, you're a business owner and there's a tax structure where you want to set yourself up with S corps and LLCs to save on, I believe it's payroll tax, and
Yeah.
we'll touch on that in a second. You mentioned something. The IRS cares about something being 100% business use. So I wanted to ask you, and I have this tug of war with my accountant all the time. A lot of these tax deductions, especially if you're writing off travel, if you're writing off cars, if you're writing off meals and entertainment, you can pretty much tell your accountant that it's for business and they have to believe you. But it becomes a problem when you're audited, if you're audited. Tell me about that tug of war. What do you have to be thinking about as you're expensing things?
Yeah. So here's the thing that you have to think about when it comes to the IRS and when it comes to your accountant. Your accountant does not sign off on the returns. You sign off on the returns that your accountant prepares.
Hmm.
So, in the event that something happens with the IRS isn't calling your accountant. The IRS is sending you letters to your house for you to deal with your IRS matter. So, who you choose as your accountant and what you choose to say to your accountant does matter significantly, because in order for your accountant to protect you, you want to make sure that your accountant understands 100% of your situation and really work with an accountant that's ethical and position you to always be in a great position if you were to ever be audited by the IRS. And so that's just the first thing that we have to understand about how the IRS operates and how your tax returns operate on a yearly basis.
Okay, that's really good information. And I'm always getting these warnings from my accountant. Don't do this or you will get audited. Keep it under this or you will get audited. Are there any like golden rules that you advise people to follow to avoid an audit or any big mistakes that somebody can make that could trigger one?
I think one of the most big mistakes that people make that can trigger an audit is doing their bookkeeping their bookkeeping and accounting so late that they have so many uncategorized expense categories.
Hmm.
And so they end up filing their tax returns with hundreds of thousands of dollars in uncategorized or miscellaneous expenses. And these categories, when you file your tax returns, actually get flagged by the IRS if they're extraneous. So if you're making $1 million or $2 million a year, but you have $500,000 in uncategorized expenses, as an IRS agent, they can easily audit you and try to figure out, well, what exactly is making up this $500,000 in uncategorized expenses, and ask for you to send over your profit and loss statement. And if their profit and loss statement doesn't depict what those uncategorized expenses are because you didn't do your accounting on time, then you're going to have to send over your bank statements. And they can go through everything inside of your business bank account and try to ask you which and what was actually truly a write off. And this can be extremely tedious. It can cost you a lot of money. And it can also cost you penalties and late fees if they do find any expenses that were on that business side that really they felt like shouldn't be a business expense. And so this is how you can protect yourself from ever getting into an audit of this magnitude, is making sure that you do your bookkeeping and accounting in real time. If your business just closed out the month of May, then you should be doing bookkeeping for the month of May by the 15th of the next month. You should already have your books. And you want to make sure that when you file your tax returns, that you get all uncategorized expenses out of your books when you're ready to file the tax return. There should be zero uncategorized expenses. Everything deserves a place, and you need to make sure of that.
And I think working with a good accountant is really the key there. That's all really good advice. Thank you, Carlton.
Of course,
Let,
absolutely.
let's talk about you and I. We are business owners with multiple entities, and taxes can get really complicated. We've got LLCs and S Corps and partnerships, and it drives me nuts. If I had to do my own accounting, I think I would probably hang myself. So, Carlton, tell me a little bit about the structure that people like you and I and other business owners need to think about. How should you set yourself up to maximize or minimize your tax burden?
Yeah. Most entrepreneurs like me and you who are, let's just say doing 6 to 7 figures, or and even some that are doing 8 figures, are going to operate inside of an LLC taxed as an S corporation or just a formal S corporation. And part of the reason why is because we don't want to overpay in taxes. You see, most business owners understand that it makes sense to set up something, but then there becomes a time where you have to switch out of that something into something that's going to save you money. And typically that's an S election. I would say that, if you have an LLC, there will become a point in time where your LLC will grow up and become an S corporation. And the reason why it will grow up and become an S corporation is because it'll get sick and tired of getting scrapes on its knees every single year by Uncle Sam and you overpaying in what we call self-employment tax in the IRS world. Self-employment tax is Social Security and Medicare, but to the S corporation owner, it's payroll taxes. You wouldn't know about payroll taxes as an LLC owner because an LLC owner is not supposed to take a salary. An LLC owner just takes distributions out of the bank account or owner's draws out of the bank account, which is just depositing money into your regular checking account. And this doesn't benefit you as an LLC owner from a tax perspective because you do not get a tax deduction every time you take money out of your LLC to pay yourself personally. But when you switch over to become an S corporation, you are required by law now to take a W-2 salary out of your business, which means the money that you're pulling out can be categorized as payroll. And now your business can receive a tax deduction for you getting paid out of your own company. Now, you might be asking, Carlton, okay, I'm taking money on my own business. When does it make sense for me to switch over to an S corporation? Well, it needs to make sense for you to take a reasonable salary out of your S corporation because the IRS does want to make sure you're actually paying yourself. So if you decide to take a salary out of your company, there needs to be enough profit from your company to justify you taking a salary. And typically in our office, we recommend that LLC owners switch over to S corporations after their business is profiting at least 50 grand. Because rather than having all $50,000 of their profit subject to self-employment tax 15.3%, now we can switch over to an S corporation and draw a salary from that 50 grand, which would probably be maybe 30% of that money, which would be $15,000. Imagine having $15,000 taxed at 15.5% or 15.3% versus $50,000 taxed at 15.3%. You're probably saving anywhere between about $5,000 to $6,000 in taxes. And that's part of the reason why we'll wait to tell somebody to switch until they're about doing about 50,000 in profit. Because to save $5,000 to $6,000 on your taxes is a big deal, but to switch over to an S corporation is an even bigger deal. So we want to make sure that it makes the right sense to now tell the business owner that you're ready to be a formal corporation and you're ready to start drawing salary out of your own company.
Great advice all around. So let's dive a little bit deeper into that. The structure that you're operating on now, I think you have 4 entities that I saw on your website. Some of them, I believe, with partners. Some of them may be alone. Is that correct? Do you have any entities by yourself?
Yeah, absolutely. Yeah. I have three entities by myself and 2 partnership entities. So I
Great.
have a parent company, I have a management company, I have an off-year C corporation, I have a consulting S corporation, I have a partnership LLC, and then I'm also a part of a real estate syndication. So I have a few different things that I'm a part of. And when
Yeah,
you
a lot of
start
stuff.
making more money, you'll start structuring your entities in different ways and you'll give your entities other entities that own them, right?
Mm.
I realized, it was probably important for me to have a company that manages all of my companies that I have going on. And I think it's so weird for a business owner to hear that, initially. What do you mean, Karlton, have a company manage my companies? They think about me hiring like an outside source to come in and help out. But no, all I'm talking about is me just establishing another entity that Karlton Dennis owns that's going to manage all of Karlton Dennis's entities that he already owns. And this creates a new tax deduction. Every time my existing entities pays my management company, that's a management expense. And now I have a whole nother business that I can take write-offs in that's been generating really great income from all of my existing entities. And so this is how we can start deferring taxes and creating additional entities that can create better ways for us to reduce our tax bill.
Interesting. So you use them to, I guess, mitigate your tax burden by operating as a management company. Now, you mentioned earlier that an LLC eventually graduates into an S Corp. Are all of your entities S Corps, or is it smart and strategic to keep them all separate? You mentioned you had a C Corp, you mentioned you had a partnership LLC. Why? Why is the structure that way? And is there, I guess, for me, my S Corp is Dr. Feldman LLC. It's just me. All
Yeah.
the LLCs pay that S Corp. I believe this is how I'm set up, and that saves me on the payroll taxes. Is your
But then,
setup
Jay, what does
similar?
your S corp pay?
What is my S Corp? What?
Who does your S corp pay though, other than you?
Just me.
Yep. Right. So then I might create another layer on top of that and say, okay, well, I'm going to have an off year C corporation that does not file tax returns the same year that your S corp does, and then move money from your S corporation into that C corporation. Right.
Hmm.
Right. Because let's just say that building that you bought didn't wipe out all of your taxes. And now you have maybe $1 million left in exposure. Well, I might create a off year C corporation that does not file taxes in the exact same year as your S corp. And I may have you move over $300,000 or $400,000 into the C corp, giving your S corporation a tax deduction, right? That
For
might
that
end up
year.
resulting in about another additional $150,000 in tax savings. But I'm moving money over into a C corp that's eventually going to have to file tax returns, right?
Mhm.
But then maybe we decide to loan money from your C corp back to your S corporation. So we can start playing some games now with this C corporation that's managing your S corporation based on how much money I pushed up into that management company. And that also means that management company can have its own vehicles. It can have its own things that it invests in that creates all additional tax deductions for itself as well.
Interesting. So explain C Corp. Obviously, the benefit
Yeah.
from what you just mentioned is that you can move money in there and delay your tax burden another year, giving yourself some time to
Yeah.
come up with something to spend that money on that's going to be a tax deduction? And correct me if I'm wrong, but what else is the benefit of a C Corp? What is that used for?
The C corporation has a flat rate 20% tax rate, and S corporations go up
Hmm.
to 37%. So that's a net 16% difference right there on my money if I'm already in the 37% tax bracket, right? So me
Wow.
moving over money, which is called an income shifting strategy, we can shift money to our children, we can shift money to an off year C corporation, right? If I move over money to this off year C corp, my S corporation receives the tax deduction in the year of 2023. But my C corporation may not file tax returns until 2024. And the money I moved over is only going to be subject to that 20% tax rate versus that 37% that I might have already been in as an S corporation. So I have a net 16% difference in savings. Now, I'm not just going to let money sit. I'm going to use money as a management company to reinvest back into my business. Now I have money that's not being taxed yet for 365 days that I can go and use it to refund my business. Maybe I want to spend that money on ads now, right? Now I can go rip that 400K on ads as opposed to writing that check to Uncle Sam. And I did this because I paid a management fee to a management company that manages my initial S corporation.
Jesus. So this sounds like some gray area, some fun stuff. You open up a C corp, which is a management company. You pay that management company a $500,000. Does there need to be any deliverables? Say you were to get audited. Is the IRS going to be like, what was the management service? What was the managing going on? This is BS. You owe a fee or no?
Yeah. So this is why tax strategy is so fun to me, because I like taking tax strategy from the perspective of the IRS, not from the perspective of, what am I doing? I want the IRS to, if the IRS were to audit me, I would want to know exactly what they would look for and what they would need to see in order for them to know that what I'm doing is truly a legitimate business with legitimate business intentions. So what
Yes.
I need to do is be able to create a business plan for my C corporation and formulate proper operating agreements that establishes the relationship between my C corp and my S corporation, which
Hmm.
also means that my S corporation's operating agreement should have inside of it why there's a C corporation that manages it as well. So there needs to be documentation on both ends of the table. There needs to be documentation on the C corporation around the services that it's performing for the S corporation, and there needs to be underwriting inside of the operation agreement of the S corp for there to be a management role and a management fee being paid out every single year. And this is information that we've come to learn based off of working with a lot of clients that have multiple entity structures and dealing with these clients' audits that have given us insight on how to leverage this code to the fullest extent.
This is powerful stuff. And it sounds like people would be crazy not to have a C Corp. For example, we're trying to reach $1 million in our main entity, our LLC marketing agency, so that we have a few months of rainy day funds. God forbid something goes wrong. But in order to get to that number, we're going to have to pay taxes on $1 million, which is crazy and probably at that 37% rate that you just mentioned. So,
Yeah.
we could start the C Corp, transfer the money over, and only pay 20% as long as we've got our ducks in a row. Are you telling me that that's a 16, 70% tax savings that we could get?
That's 100% correct. Yeah. You can establish an off year C corporation with a fiscal year end of September of next year and move money over. And 4 months and 15 days when it ends its year is when it will have to file its tax returns. So if I established a C corporation, let's just say right at the end of the year in December, this year of 2023, and I create the C corporation to have a year end of September. Well, 4 months and 15 days, right? Because April 15th is 4 months and 15 days at the end of the year. Four
Hmm.
months and 15 days from the end of my C Corp's fiscal year is when it has to file its tax returns. So that technically wouldn't be until January of 2025. So
Jesus.
this is a strategy that you can play all the way up until the end of the year based off of the net profits of your S corporation.
So Karlton, you're blowing my mind right now. Why don't people have C corps? Are there any drawbacks? Are there any
Yeah.
pitfalls?
Yeah. So initially, the C corporation gets a lot of hate because there's double taxation when you take money out of C corporations. So if
Hmm.
I was operating my company as a C corporation, first off, it's not considered a flow through entity. So what that means is I actually have to pay taxes in my C corp, and then I have to pay taxes personally anytime I want to take money out of the company. Whereas an S corporation, it's all flowing into my individual tax returns, all the business's profits and all of the income I take out of the business. And I only pay taxes just on one single tax return. And this is part of the reason why most people will go down the S corporation route over the C corp, is because they know that they want to take a salary out of their company and they don't want to be faced with the double taxation. But what if you had an S corporation in combination with a C corporation? You get all the benefits of an S corporation, you get all of the flow through benefits, but you also have a C corporation that's set in a different fiscal year that you can send money up to and create a tax deduction for your S corp every single year, with the ability to use those funds that are taxed at a lower tax rate without drawing a salary from the C corp.
This is all crazy stuff. Thank you, Karlton. I don't want to spend too much time on the interesting stuff, which is what we're at right now. I'm getting a ton of value right now. I know the audience is too, but I'd love to pick your mind on some of the next level stuff. See, as you level up from where we are now, or maybe we're where you already are, but the ultra wealthy, the people that have amassed such a large sum of money that they're just trying to protect it, minimize their tax burden, and they're willing to go that extra length. Tax attorneys, overseas accounts, trust funds. What are some of those vehicles that the ultra wealthy can use to minimize their tax burdens? Why does Donald Trump not pay taxes?
Donald Trump pays pretty much virtually no taxes just due to all the real estate losses that he has. He's one of the most notorious real estate investors in the United States. I mean, this guy literally owns hotels and golf courses. I mean, some of the best real estate you could possibly own is in Donald Trump's name or has Donald Trump's brand on it. And
Right.
he's been honestly exploiting the accelerated depreciation laws for years. And part of the reason why he created the Tax Cuts and Jobs Act. He's one of the few wealthiest individuals that actually keeps everything on shore and shows everybody that by his ability to constantly reinvesting in what works, which is commercial and residential real estate. Donald Trump is somebody who's definitely provided a lot of affordable housing in New York. I've studied a lot of his works just for depreciation purposes, and it's definitely something that I teach other people to do inside of my coaching calls. When it comes to some of that more advanced stuff, you'll start to see some business owners move items out of their estate. And the reason why they'll do that is because there's an estate tax exclusion that we have of about 24 million that sunsets after 2027. When I mean by sunsets, it ends after 2027 and it reverts back to the previous laws before the Tax Cuts and Jobs Act, which really only gave people about 11 to 12 million that they can put in their estate without it getting subject to estate tax, which can be as high as 40%. So what many people will do is they'll try to get assets out of their state by setting up irrevocable trusts for a better pronunciation of it. So when they establish these irrevocable trusts, they're taking assets out of their estate. But they may have multiple assets. It could be stocks, it could be businesses, it could be investment properties. So they're setting up multiple different trusts, maybe business complex trusts, family trusts, foundation trusts, because they're philanthropic as well. And all of these trusts have a relationship to each other. And all of these trusts have assets that get moved. And this is how you're able to build wealth strategically and also fly under the radar, because creditors are not allowed to get into trust. They would have to go at the Supreme Court level because it's contract law that we deal with when we're setting up irrevocable trust.
So what is a trust? What are the tax benefits of having one? And why can't me and you have a trust? Why don't we? Maybe you do.
Yeah, well, I definitely have a trust, and I would definitely recommend that you get a trust. And most taxpayers should have a trust. A trust is a means to pass something off to beneficiaries. I look at it kind of like a baton in a relay race. If, God forbid, something were to happen to me, I would want to make sure that at least that baton gets handed off to the next person in line, right? And so if you establish a trust, you're pretty much protecting the assets that you've created and making sure that they get passed off to the next beneficiary. So if I have children, which I do not yet, I would want to make sure that my children can get my house and my investment properties, my IRAs, without having to wait 6 months of what we call probate. Probate is this process where the banks will determine what assets are owned truly by Karlton, what assets are owned by Karlton's spouse, and what assets are actually entitled to his children or any family members. And they take about 6 months to figure this whole process out and then divvy up the assets. But what they don't tell you is during this 6 month period, other people can come. And when I say other people, like literally other family members, other relatives, even other business associates can come for your estate during this probate process, extending out the ability for your children to receive the assets. all while your taxes are due within 6 months of your death, and your children have to start paying on whatever assets that you might have left behind, such as mortgage notes and assets like vehicles and things of that nature. And so it can become a very big cumbersome to a family that's trying to get over a loss of a parent or a family member, right? And so when we establish the trust, we're actually protecting ourselves, and we're actually getting a really great benefit called step up in basis. When you have an asset that you purchased, maybe your relative purchased it or a mother or father purchased it, most times properties go up in value if you hold on to them long enough. Well, you want to make sure that you get to capitalize on that appreciation. In order to capitalize on that appreciation, your parents could put your properties inside of a trust, or Jay, you could put your properties or whatever your assets you have inside of a trust, and your children can receive those assets when you pass away or when something happens to your parents and you receive those assets. But here's the thing: when you receive those assets, you're getting a step up in basis. So whatever the price that they bought those properties at no longer matters. What matters is, what is the property worth when they died? Because you can turn around and sell that property and not experience any capital gains taxes because the basis has been stepped up due to the date of death.
Interesting. Definitely a great benefit there. What about
Yeah.
offshore accounts? Is there any benefit to opening an offshore account? Is this something that the ultra wealthy still utilize?
I would say that there's only a certain amount of people that even go down the route of trying to establish offshore accounts. And typically you'll see this in the investor space.
Mm.
Most investors are investing with various different bro- brokerages and different accounts online, and they like to hide their money online in various different off count shore or in various different accounts offshore. And
Mhm.
so if I'm somebody that's trading, I can trade through any type of bank account as long as it's linked to my trading platform. So if I go establish a trading account in the Bahamas or establish a trading account in Switzerland, I can set up an LLC, have my assets moved over to this country, maybe even have my trust moved over to this country, completely getting my assets offshore. And a lot of taxpayers will go through the hassle of paying thousands of dollars in attorney fees to set up these complex structures for the ability to have their assets be protected, to have anonymity, and to make sure that their assets can also sometimes grow in a tax advantage country.
All right. Awesome. That's good advice. Probably not going to open an offshore account myself anytime soon, but I definitely see the appeal.
Yeah.
Carlton, if you don't mind, I'd love to hear some opinions on where you think the government's going to go with tax law. I follow this stuff pretty closely on YouTube.
Yeah.
Feel free to opt out of any of these answers. But I hear lots of rumbles, lots of rumblings online about a couple different things. One, wealth tax, and two,
Oh,
potentially getting rid of the employee payroll tax deduction that we just spoke about earlier with the S corps LLCs. What do you think they're going to do? What do you think the right thing is going to be, and how can we prepare ourselves?
yeah. It's a tough one, the right thing to do, because America has been taxing us like crazy over the last, I don't know, 50, 70 years, and we're in more debt than we've ever been before, ever. So it's almost like you feel like, does really taxing the wealthy or even increasing taxes for anybody, will that actually solve America's problem? And I would answer no. But the thing is that politicians have to turn to something, right? They can either, cut government spending, which, doesn't get them reelected, or they can turn to taxes. And typically, when they turn to taxes, we're either hearing something positive because the economy is doing well, or we're hearing something negative because the economy is doing bad and they want to increase taxes. And at this current moment, the economy is bad due to the amount of printing of money that went on during COVID. We released trillions of dollars into the economy. And now we're feeling that wrath of what it's like to have inflation. But here's the thing: something has to be done. And right now, the answer is, should that something that needs to be done is increasing the taxes on the wealthy people. The wealthy people, in the eyes of the government, are people who are making over $400,000 a year. And they want to also implement some type of billionaire's tax. If you have a net worth of $1 billion, there should be a special tax that you're going to pay just for the amount of income that you have received, or the amount of net worth that you've been able to amass over your lifetime. And so I think that these are penalties to most who look at it, and solutions to those who feel like there needs to be something done. But in my eyes, I feel like there could be better solutions that we come up with as a country that does increase taxes momentarily, but also provides benefits for the things that would help stimulate the economy at the same time.
I agree with you. It's interesting to see what they're coming up with and what the ramifications are going to be. And some of it just sounds ludicrous. For example, people
Agreed.
with worse credit paying a higher percentage to cover the people with better credit on the mortgage rates. I don't know if you've been following that. Just lots of craziness that's going on there.
New
Karlton,
proposals every week, man. I
yeah,
swear.
new stuff
It's
every
always
week.
something.
But the thing of it seems like the past year, and it seems to be picking up steam, is the ERC tax credit. These people feel like vultures. I must have had 100 people in my emails and DMs trying to sell me on ERC services.
Yeah.
And my accountant swears that the IRS is going to be repoing millions, even billions of dollars in fake ERC payouts. I'm sure a lot of people listening, especially entrepreneurs, have been pitched for this ERC. Can
Yeah.
you brief me on ERC and give me your opinion of it? Do you think that this is a good thing for a lot of businesses? What do you think is going to come out of it?
You know what? The ERC credit gets a lot of shade because you see a lot of people who do not focus in the tax space promoting the ERC credit because they read the fine print.
Yeah.
That is truly what it is. A lot of businesses read the fine print of everything that was going on during COVID and then found this credit and was like, wait a second, let's just move forward with it and see if we actually get the refund. And it turns out the refund actually does come out. The caveat is you have to sometimes refile your tax returns, taking off deductions that you previously had, and then you get the refund and then you pay the difference. So it's not like you're just getting free money. The money is coming to you, but there's items that you have to do in order to make sure that you're getting the money free and clear. And so there's been a whole, slew of people that feel like this industry around the ERC is not legitimate because there's people who are just selling the dream of getting a refund for just being a business owner who survived COVID. And the truth of the matter is that there's just a little bit more rules around it. We've helped hundreds of clients receive this ERC credit, but it's really because we're helping the right type of customer who actually needed that ERC credit and did specific things that the IRS wanted them to do. And that's who the credit was created for. If you were a small entrepreneur and you had 5 employees or more, and you were going through economic circumstances that are listed on the IRS's definition as economic circumstances during those 2 years, then you can apply for this credit and determine if the IRS is willing to approve you for it or not. At the end of the day, credits do not stay for long. So the ERC credit is one that I am helping entrepreneurs receive because it is something that can make a difference to help the entrepreneur grow during this hard time period that we're in right now with the economic, turmoil that we're in with inflation. And so if you're a business owner and you're trying to figure out, is the ERC legitimate? What you need to ask yourself is, how do people actually qualify to get the ERC credit? And which companies are the ones that make the most sense for me to align myself with? Because there's tons of people who can be here for today and gone tomorrow.
I think that's key. I think you couldn't have said it any more perfectly. Thank you for shedding some light on that. A company or a person that you trust is going to be there 5 years from now if they come knocking. So you are
Yeah.
accountable for making sure that the person or company that you're representing to get that credit actually is a good candidate to receive that credit and get the benefit. Thank you, Karlton. I've
Absolutely.
kept you for a lot of time here. I've got another question that I need you to answer for me, brother. As a tax expert, as someone who does this for a living, why do you live in California?
That's so funny. I get asked that question all the time. You know what's funny? Living here in California, you think I'd probably pay so much in taxes. But the
Yeah.
truth of the matter is I pay 0% in taxes because I wipe out my income every single year. My exposure is only on the California side. So I
Mm.
call it pretty much the luxury tax. The luxury tax of me paying 9% on my total net profit versus an average business owner paying 30 to 40% on their profit. I think I can live with that. I've never invested in real estate in California. I've always purchased my investment properties all out of state, which gives me the
Mm.
flexibility to eventually change my designation if I choose to. But this is home for me. This is where my family is. And to be completely honest, this is where I see myself raising a family and being able to have memories here. And so, if I want to be able to have the things that I want, I need to be able to make sure that I do everything in my possible power to leverage my situation. And leveraging my situation is making sure I'm not paying any IRS taxes. If I'm going to pay any taxes, then I better only just pay that small amount of California tax. I don't want to pay the high federal taxes that go all the way up to 40%. I'll pay the California taxes that only go up to 13% and make sure I'm not paying the highest of that. And so that's something that I've had to accept as a tax strategist and part of the reason why I live here.
So, important note there. Some highlights are: if you're going to live in a high tax state, you need to figure out the system. And it seems like you've figured out the system and made it work for you. So, kudos to you. And for those listening that want to learn how in a little bit more deeper and a more profound understanding, where is a resource that you can point them to, whether it be an online course, a book, that's going to help them master tax strategy to live anywhere in the world, kind of like you do?
Yeah, absolutely. Guys, listen, there's so much free content out there, and I pride myself on trying to put out the best YouTube content for tax strategy. So feel free to go to YouTube. I would say it's a great resource to get information on how to reduce your tax bill. But as you know, there will be certain information that's just kept behind closed doors. And that's why I encourage you to schedule a complimentary consultation with my tax team so we can uncover some of the additional strategies that can really help push the needle with you and your business. If you're somebody that's trying to leverage the tax code, maybe real estate might be that option for you. And we have a business called Tax Alchemy that helps business owners or helps W 2 taxpayers use real estate to be the means to reduce their W 2 or their 1099 income taxes. If you have any questions on that, I definitely recommend visiting our website at taxreductioncompany.com. And so we can help you out.
And Karlton, I'm going to drop your YouTube down there in the show notes too. If you've listened to this episode, you've been quick to answer and verbose with every single response that you've had. He's charismatic, he's entertaining, and he's got a fast growing YouTube channel. So definitely check that out. Karlton, who's an ideal customer for you? If you're looking to reduce your tax burden and you need a little help, who should contact you? Who's a good fit?
Yeah. So someone who should contact a tax strategist is somebody who knows that they already have an accountant who files the returns, but they're looking for somebody that can help them reduce their tax bill. You see that there's two different conversations that you can have with somebody that's in the tax space. You can have a conversation around what items to put inside of a return to file the return, but you can also have a conversation around what actions you can take to pay the least amount of money possible. I'm the person who helps you create the actions that can lead to you paying the least amount of taxes possible. And when you feel like you're at that point where there's not enough that's being done with the accountant, then we can get a tax strategist to formulate ideas to reduce your tax bill. And so if you're a W 2 taxpayer, you know when you're starting to hit those 6-figure years, multiple six figures, that it's time for you to figure out what you can do outside of just maxing out your 401k. And if you're an entrepreneur and you already have an S corporation, you're already taking the payroll, and you've already maxed out your 401k or SEP, then you know that there's other things that you can be doing outside of just spending money on more vehicles, right? And so that's when you need to look for a tax strategist, someone who can help align themselves with your lifestyle and create additional deductions and strategies on the tax return to keep you more tax free.
And just to reinforce that, you couldn't be more right. Your accountant is not going to try and save you money on taxes. Their job is to keep you out of trouble. I have a very good accountant, and I asked him for years to help us save money on taxes. Nothing. Our tax savings, the bonus depreciation, was a result of me watching 100 hours of YouTube videos and having conversations like this and bringing them to my accountant and saying, is this going to work? Let's try this. My friend says this is going to work. And finally, one of them hit. So definitely talk to a tax strategist, pick up the phone, schedule a meeting with Karlton's team. It's going to be worth it for you. Karlton,
Yeah,
thank
and if
you,
you
brother.
want to
This was
save hundreds of hours, you could just
hundreds
schedule
of
a
hours.
consultation with my team, and we can explain it all to you in probably a 30-minute consultation.
Yeah, do yourself a favor, save you the time.
Thank you so
Thank you,
much for having me
Karlton.
on. Pleasure.